This is the second session of the financial management head start for young dentists, and I see more people than last time, so it's growing. I'd love to see that. So today's topic will be I'm talking about the 4 different types of business entities and how they are taxed. Again, very basic stuffs. However, I figured that many of our colleagues are not too familiar with even the basic stuff. So I think it is better for me to just discuss about it. And if you want to know more about it, you can expand your research or we can discuss about it in offline. All right, this is the main disclaimer. So I am not an expert of the tax accounting or financial management, and I do not have any responsibility regarding the information discussed in this session and your decision that you make based upon this information. So please do research before you make any decision. And if you want a professional financial advice, then please talk to a licensed CPA, professional financial advisors, or services to get the most accurate and personalized consults regarding your individual personal financial situations. And for our international colleagues, i.e. you do not have a green card or not a US citizen, please discuss with your current situation with your lawyer or the DSO of the school before you make any financially rewarding activity, because I know the visa is a huge thing for you guys. And I don't want you guys to be kicked out of the country because of like a few dollars. So before I get into the details of today's session, there are some IRS forms that you need to understand. So if you've been filing those taxes, you must be familiar with the IRS Form 1040, which is the US individual income tax return. The image on the right is the form used in 2019. So tax year 2019, so what you filed last year in 2020. So as a US individual, you need to file the 1040 form to IRS every year. And another important form is Schedule SE for self-employment. So if we want to become a self-employer, i.e. you own your own clinic, then you need to file the Schedule SE along with Form 1040. And Form 1040 NR is for the non-resident. So if you've been living in the States for less than 6 years, so up until the 5th year, you file the 1040 NR if you don't have the green card or the US citizenship. However, since the 6th year, you will be a tax resident and you will have to file the regular 1040 form as a resident. But that doesn't mean that you have a green card or a like immigration resident. So please talk to your lawyer and your CPA if you're international, and if you have to file 1040 NR, or discuss with him or her if you need to file 1040, regular 1040. And the other form, W-2, if you get employed, you're hired by somebody as a regular employee, then you get Form W-2. Usually you get it in January or February of the next year, that how much you have made and what your benefits, how much you got compensated, cash or non-cash, and all the this is the pay stub of 12 months in one sheet. And the other form, as a future dentist, important form is 1099. Well, actually 1099 has many different variations. However, the 2 most important forms are 1099 miscellaneous and 1099 NEC, which is non-employee compensate. So these 2 forms are issued to the contractors. So if you become an associate at a small clinic, and if you work as a, how should I say, a contractor, not an employee, then you will get 1099 form instead of W-2. So if you work at the huge corporate and get all those benefits, like corporate benefits, then you're probably gonna get W-2. But if you work in a smaller clinic and if you want to be an associate, you will probably get the 1099. It's not 100% consistent with what I just said. So before you get the job, you probably want to look into which form that you will be issued at the end of the tax year. And the next form is Form 1065, which is called as the Schedule K1. That is important form for the partnership. I'm going to discuss about it later. And Form 8832 is the declaration of business. So this defines what kind of business you have, and you let the IRS know that which business you will have. So next important thing is how to calculate ordinary income tax. This table was covered in the previous seminar, but some of us had hard time how to calculate the tax. So I brought this again. So when you tax something, I discussed about how the taxable income is important than your actual gross income. So that is called adjusted gross income, which is AGI. And each individual income is topped up, which means the last bullet. So if you work 2 part-time jobs, you gain from the investment, which you sold in less than 1 year, interest from the savings and profits from your own business. And you just have to add them up and then calculate the income tax based upon the entire sum of your income. So one hypothetical situation, you made $150,000 in last year and you contributed $6,000 into traditional IRA, and you can use whatever deduction you want to put as long as it's recognized by IRS. But to make it simple, let's use a standard deduction. Even if you didn't spend any money, that amount of money will be deducted per IRS. You can choose to deduct that amount that's allowed by IRS, and that will be subtracted from your gross income to calculate your taxable income. And per se, you're a single and have no dependent for tax purpose. So adjusted gross income of yours will be your gross income $150,000 minus the deduction, which will be 150 minus 6,000 for traditional IRA and 12,400 for the standard deduction of 2020. So your adjusted gross income will be $131,600. So let's plug that into the table on the right. So first, about $10,000 will be in 10% bracket. So that will be about $1,000 of federal tax. And then next bracket, 12%, $3,600. And the next bracket, about $10,000. And then the final bracket will be 24%. And that will be $11,000. So the net of the federal income tax will be $25,662.92. And again, you will have to pay Social Security tax. You will have to pay the Medicaid tax. You will have to pay the state tax and the local tax. But to calculate the federal tax, which is the biggest portion usually, that's how you calculate your federal income tax. So let's get into the main topic, the types of business entities. There are 4 major types. Sole proprietorship, usually shortened into Soleprop. Partnership, which is quite similar with Soleprop, but I will cover it later at the dedicated slide. LLC, limited liability company, which is the hybrid between the Soleprop and the corporation. And corporation has actually more than these 4 subtypes, but I just brought 4, just for example. But C and S corps are the most important types of the corporation. And each state has different regulation how to tax or regulate those types of business entities. So the first type, the simplest form, the Soleprop. So for the Soleprop, you are your own business. So the everything is shared with you and your business, which means the profit is shared with you and your business, which is calculated in one huge chunk. The liability, the expenses, everything. So it goes onto your 1040 form, which is individual tax return form. So you gotta attach the Schedule SE self-employment form um, on top of your 1040 form. And if you see the image on the right, you can see on the top left of the image on the form, it's for the form 1040 or 1040 SR. SR is senior resident or something. So we don't have to worry about it for quite a long time. So usually you use your own name as your own business. However, you can use a trade name, which is your business name. That is also known as the doing business as, shortened as DBA. And most states require you to register your business if you're using the trade name. However, if you're using your own name, not all the states are requiring you to register. However, I looked it up, New Jersey does require, even if you're using your own name for your Soleprop, and that form is Form NJ Rec. You can just Google it if you wonder about it. And so because yourself is your business, you don't have to have the EIN, the separate number for your business. You can just use your social security number to do the business. However, you are planning to employ other people, yes, you need a dedicated number for tax purposes, which is called employer identification number. So you will be the employer who pays to one or more employees other than yourself. So again, the profits, losses of the Soleprop goes to your own Form 1040 as the attachment form, Schedule SE. So partnership is basically a Soleprop shared by 2 or more people. So again, this form partners, yourself is your business. So partners, each partner is the business. However, they are not employees. You do not hire them. They own the business. So the third bullet, the partnership, the company itself doesn't pay the income tax because the profit and losses will be passed through to each partner, and then it will be topped up on each one's 1040 form. So that's the biggest difference between the partnership and the corporation, because corporate, they tax on their profit as a whole company. So each shareholder of the corporate will be in the different tax rule compared to the partners of the partnership form. So the Schedule K1 is the partnership specific form, which is on the right-hand side. So this form tells IRS which of the partner has ownership, like how many percentage, like Mike and I own this business maybe 60-40, and then we share the profit 60-40, we spend expenses 60-40, and then we put it down on this K1, and then we let the IRS know. So the third form is limited liability company, which is finally different than the first 2 formats, because LLC, finally, you are not equal to your business. That's why it is called limited liability. So the company's liability is not shared with the owners. So per se, you messed up someone's tooth really bad, and your patient want to, could you mute, please? Go ahead. And Pedro? Can I read these people? Not while I'm sharing, I guess. Anyhow, so you get sued for doing a horrible job. Then if you own a sole prop or if you're a partner of a partnership, yes, all you own will be collateral for that. So if the judge give you the verdict that you gotta pay $5 million to this patient, then yes, the patient can claim your house and your car and everything that you own. However, this LLC, you can just bankrupt this LLC and just stop caring about it. Well, is it gonna be good for your future business plan? Maybe not, but I guess you will still own the house that you can sleep under. And I guess that's the single biggest benefit of having the LLC compared to the sole prop or partnership. So this is a hybrid form. Some aspects of the LLC resembles the sole prop, some aspect resembles the corporation. And again, this limited liability thing is the single biggest distinguishing factor between the sole prop and partnership and the LLC. And with the corporate, there are different tax rules. So anyhow, the third bullet, the articles of organization, is the declaration paper for the LLC. And you probably want a lawyer to be involved. You want to hire a lawyer to write the thing and then submit it to the regulatory, the state government. So this one sets a boundary of everything of this business, the profit and profit sharing if you have more than one owner of this LLC, and expenses and liability and everything. So this is basically the counterpart of Schedule K1 of the partnership. And operating agreement, another paper that you declare with your partner in the LLC. Again, the partner in the LLC is different than the partner in the partnership, because partnership, each person is unlimited, the liability is unlimited, and this LLC, your liability is limited. So the operating agreement is not mandatory in all states. I think Jersey, it's not mandatory here. There are only a few states that it was mandatory. So without this operating agreement form, the liabilities, profits, and everything will be equally distributed or follow each state's default setting. Usually, equal cut, like 1/3 to each partner of established by 3. But if you submit this page, then you can tweak this thing and then you can do 60/40, 70/30. So there are some benefits of this LLC because this is hybrid form. You can take the benefits and downsides of sole prop and corporate. So again, the single biggest benefit of this LLC is the owner is protected from the liability. So you're not going to lose your house and mortgage and everything. And this is less formality compared to the corporate. So you don't have to hold the shareholders meeting like annually or biannually or semi-annually. And you can just run it without asking like hundreds of people. And LLC, you can use the cash accounting method, which is usually simpler compared to the accrual accounting for C corporations, for the bigger companies. And you can have tax advantages for LLCs. So compared to the corporate, this tax advantage, if you make the profit, you only tax once for the LLC. However, for the corporate, you will be taxed for the profit and the dividends that you share with your shareholders. So for the corporates, you tax twice. However, LLC, you only tax once for the profit purpose. However, downsides, you have the FICA obligations. You have to pay the FICA taxes, which is the Medicaid and Social Security taxes for your employees and yourself, because you own this place, and then you gotta pay the FICA tax for yourself for self-employment. So again, that was 6.5% is paid by your employee, and you gotta pay another 6.5% for the Social Security and 1.45% for the Medicaid for your employee. And the employer yourself, you gotta pay another 1.45%. So that adds up. And the second bullet, you must report the profit immediately. That means you gotta pay tax for the profit every single year. For the corporate, you can carry over your profits, and you can defer the taxes to the following years. That can enhance your cash flow. But for the LLC, you gotta put that, you gotta report the profit every single year. So you gotta pay the tax on the profit every single year. And the employee benefits will cost the employees. What that means, so if you are providing the medical compensations, or if you're providing the transportation compensation, you're paying for the parking fees. For the corporates, it is not taxed for the employees. However, if you provide those benefits, it will be counted as the cash benefit for your employees, and they gotta pay the income tax for those benefits. So it is harder to recruit the employees on that aspect. So finally, the corporation, which is the most complicated format of entity, and you probably wouldn't want to worry about it right now, because I don't think many of us will start a huge corporation right off the dental school. And if you're planning to do it, you must be the expert, way better expert than my minuscule knowledge on this business. So corporate is an animal of itself. So it's a completely independent entity. So it's not like the Soleprop, not like the partnership, and not a hybrid like the LLC. This is a separate entity, and the owners or the CEOs of the corporate, they are not liable for the corporate risks usually. So two major forms, the C Corp and S Corp. The C Corp, if you look into the market and the corporates you heard about, like Ford Motors, GM, or any like huge corporations, most of them are C Corps, and they could be taxed twice, like I mentioned before. And those two taxes come from the profit, and then when you share the profit, the dividends, it's called dividends to the shareholders, that one could be taxed. And for the C Corp, you can sell the portion of the company, and it is called shares in the stock market. So S Corp is a special, S stands for the special. So this is actually better for the smaller corporates, and you can avoid the double taxation on the dividend part. And the number of the shareholders are limited to 100 people, and they have to be US citizens. So again, this slide, maybe not the best slide for our situation, but because I decided to mention all those business entity types, I just added it. So what do you think your first employment tax form would be 1040, I mean, 1099 miscellaneous, 1099 NEC or W2 or Schedule K1. If you want to start your own partnership, then that could be Schedule K1. That's my goal for my first employment. Or it could be 1099 as a contractor in a smaller dental clinic, or the W2 as an employee of the bigger clinics or corporates. And which format do you want as your first practice? Soleprop or partnership, share with one or more partners, or LLC. So even if you get sued, that you don't lose everything, or a corporate because you know what you're doing. And that concludes today's session. Again, that was very basic of the businesses and how they are taxed. Do I have any questions?